Please welcome to the stage James Haft from CryptoOracle, Sripada from Bubblo, Jeremy Gardner from Awesome Ventures, and Cliff Sarkin from DNA. Come on up, guys. Cool. They all got the fancy mics, and I'm stuck with this thing. I see how it is. All right, guys, so first off, thank you so much for being here. I'm very, very excited to have you guys up on stage. Each individual up here has been, world class so far, and with the exception of me, we haven't ruined that today. So thank you guys for coming. So just to keep it super flowing and easy, I'll start with you, James. I'd love everyone to just give a super brief 30 seconds about themselves.
I'm James Haft. I'm the co-founder of CryptoOracle with my partner, Lou Kerner. We're raising a $100 million fund to invest in protocols, platforms, and exchanges that need to exist for the decentralized economy to thrive.
Shank?
Yeah, I'm Shashank Sripada. I'm the CEO founder of Bubblo. We're an artificial intelligence company, like Series B stage, and we got into crypto and blockchain. I'm also an investment director at Marcina Capital in London. Advise over $5 billion of capital. Did a lot of VC investments, very different space.
My name is Jeremy Gardner. I founded Augur, the Blockchain Education Network, Distributed Magazine, and a couple other things. Most recently, I launched a hybrid venture hedge fund called Awesome Ventures.
I'm Cliff Sarkin. I'm the COO and General Counsel of DNA, which is a global crypto investment bank and consulting firm founded by Brock Pierce and Scott Walker.
I think there's a little feedback. Might have to move up your. I don't know if one of you guys has to help, but so it might be me. I'm always causing trouble and feedback. So the first thing I always like to ask people who run crypto funds, because we meet so many folks who say they're running crypto funds, but there's a big difference between one fund and another, and the easiest way to find out if somebody is serious is to ask them what makes them different, because a lot of people will just be confused what that means in general. And if you're running a crypto fund, you should absolutely not know that that is a trick question. It should be fairly simple. Every fund is different. So James, why don't we start with Cross again? What makes CryptoOracle different from other crypto funds or venture funds or hedge funds?
Well, first of all, our philosophy is community first. So we founded Crypto Mondays, Crypto Tuesdays for the social good. We just ran a conference for 4,000 people at the Moscone Center, where we had 40 stages and 180 speakers. We put ourselves at the middle of the community because we believe in crowdsourcing. We believe in the intelligence of the crowd. So we want to meet great people and hear what they're doing, and then figure out how we can collaboratively do better. And then on the side of the fund itself, we've created a structure where you can invest in the early stages of the biggest and best platforms, protocols, and exchanges as a VC, but have liquidity on the day of your investment. So you can have the long-term play, early access to transactions, and you can have immediate liquidity. So we try to be different on both sides.
Cool. Shank, I have a bunch of thoughts, but I'm gonna let everyone get through because I bet there'll be similar questions and we can all start to argue about stuff. It'll be great.
Yeah, I mean, in terms of like actual investments, crypto funds, we've been looking at investing in crypto funds. Haven't hopped in there yet. I myself have been too busy on my ICO to worry about it, but the thing is, I represent a lot of more older money, a lot of family offices, and they're a bit scared to get in. It's a bit, it's unregulated, and there's been a bit of a bit of a difference between what is a crypto fund. Is it operate as a VC? Is it doing due diligence based on a VC model, or is it a hedge fund? They both seem to be entering at an early stage. They both seem to be making trades and making great returns, but it's been a bit hard to decipher.
I'll reframe the question for when it gets to Jeremy so he can address some of that stuff. So, what we do at Wavemaker Genesis, so I didn't really introduce myself aside from running the conference. I'm principal at Wavemaker Genesis. We basically bring an early stage venture model to the crypto space. our funds are generally structured as hedge funds. So, but we model it like a venture fund. Jeremy, is that your experience with your fund, or how do you sort of address some of his questions? Because I know there was a few in there to unpack, like the older crowd, unregulated.
Well, even bigger for me is we're not a hedge fund because we don't believe they're actually the tools to hedge with. You know, you have 200 new funds in this space, but how many of them are up after March? Not many. I think the whole concept of a hedge fund in an industry where there aren't the financial instruments to go short on the vast majority of assets in the space is kind of a fallacy. So we have a venture structure and really take a long-only approach where we actually have a social impact thesis where we believe the majority of good use cases for blockchain technology will fundamentally make the world better. That's maybe 60 to 70%, and that's what we focus on. So the investments that we make are long only, and they're with the intention of investing in technology that if they're successful in 7 to 10 years, they'll have dramatically made the world better. We don't worry about the short term like most of the hedge funds out there.
So more like a venture fund, obviously, because most venture funds take 7 to 10 years to get a return. Do you guys hold tokens?
Yes.
Can you hold tokens?
So that's why we're a hybrid fund. We actually have the capacity to trade liquid assets, including crypto tokens, SAFs, and so forth.
Oh, very cool. Cliff, tell us a little bit about DNA and what makes you different. And
Sure. A couple things. One, we're super selective. We're really going after the top 1/10 of 1% of crypto projects out there. There's a lot that is great, but we're looking for the best of the best. I think the other thing that sets us apart is we're more than just a fund. We provide a lot of value-added services. We help companies pre-ICO make sure that their crypto economics, tokenomics, velocity, so that once they're ready to launch their ICO, they're in a position to be successful, and then even post-ICO services. The other thing that DNA is really a community, a platform. Even if we're not investing in certain companies, we love to bring our community together and allow investors, advisors, entrepreneurs to meet each other, and it's an honor to provide that platform in addition to investing.
very cool. So, you did mention March, and a lot of the funds have not technically done that well, and even last year, so like 2017, I know I'm preaching to the choir, but in case you didn't see some of the data research, I think the crypto market as a whole, it's not perfectly scientific, but if you look at something like CoinMarketCap and you look day one on 2017 to the last day of 2017, the market went up 2,900%, which is like, 100x better than the best hedge funds in the world, right? But that's obviously an anomaly. It's craziness, but we'll see what the future brings us. But at the same time, we saw articles in Bloomberg saying that the average crypto hedge fund made 1,100%, which is about a third, a little better than a third of what the market did. Any hedge fund manager in the traditional world, if they did a third of what NASDAQ did, they would be considered the worst investors out there. So, but in the Bloomberg articles, they were praising them for saying how amazing the returns are at 1,100%. You could respond in a bunch of different ways, right? You could say we're doing it in a less risky structure, we're doing it in different ways, and that's why we had it. But most people don't tell you why they're different, like we were talking about before. But so, I mean, Jeremy, you were talking about the average person getting through this last hump and if they're ahead or not. What do you think is the thing that does set the folks apart who, are now still ahead after the last, 4 months?
The only people that are ahead right now are the people that were able to short the market or took their capital out. That's it. There was not a single crypto token that was up over the past 4 months. So you had, those were the only two strategies, and that whittles down of a couple hundred funds out there. I think there were like 4 or 5 that are up right now, and a few that are flat, but the vast majority of hedge funds are down right now. Yeah. Now venture funds can be up because they're long term and they're not thinking about quarterly earnings, but
yeah, I guess individual investors could be very far ahead if they got in at the beginning of 2017, even if they're down from their peak.
Well,
right?
my fund launched a month ago, so we're up 50%, but that was just good timing.
Brilliant.
You want to like say some random weird disclaimer so that you don't get in trouble? So James, I think across the board we all look at very early stage companies, and that's a part of the model. And I think that's actually, being, obviously it's self-serving because that's our model as well, but like, I believe that's the only way to get to those, if there ever is this crazy year like there was in 2017, to get to those astronomical returns, is to be at that earliest stage. What are you seeing today at the earliest stage that excites you the most? Everybody seems to be looking at the sort of the platforms and infrastructure type plays, but is there any specific company or idea, like vertical, that you are loving right now?
Well, first of all, I totally endorse the concept of blockchain for the social good. And I think that when you're talking about these platforms, they're not businesses anymore, they're networks. And so you're really talking about how many points are in the network, how many nodes, and those nodes at the end actually end up being people. So what we're looking for are those platforms that can end up touching hundreds of millions, if they get lucky, to 1 billion people. And there's never been a time in humanity when you could grow a network that fast as you can do it today. So we're looking for those asymmetrical opportunities where platforms can come in and other modalities can come into play and touch hundreds of millions of people within 3, 5, 8 years. And we think those will be the successful cases. And we hope that to support those that will have a positive impact on humanity.
Shank, similar idea. I mean, that's a tough response to follow, but there are other verticals, other ideas. Is there something that you really have gotten excited about over the last few months?
Sure. I mean, the thing is, like, my view and what I've been preaching to a lot of my families as well is that it's not necessarily different than any venture capital out there. I mean, like he was saying, if you're going to invest in the short term, you're going to lose based on market swings. We love all sectors. Anything infrastructure is obviously great. For my own company, it was a business model that was working that we supplemented with blockchain. We didn't create a whole idea around it necessarily. So I think what you have to look at is, what's actually going a solid business model, what's going to grow in the long term. What I think blockchain did was more provide liquidity to long-term investors, provide another option. That's what is most exciting as an institutional investor, is that you're not locked in for 7 to 10 years. You can offload your position and maybe buy it back, but you have those options with the ICO. It doesn't mean you're just gonna dump everything and make a quick buck necessarily, because as he mentioned, in the short term, not many ICOs necessarily do that well. So I think it's just provides more liquidity, it democratizes investment, you're not the only one in the gate. You have a bunch of people who believe in the idea and a community to support it, users to support the product. So I think it opens up a lot of consumer plays. It opens up a lot of incentivized behavioral plays, and that's kind of what's exciting.
Can I?
Yeah.
So to throw in a thought that's, I think, in line with what's being said, this is not something different that's happening now. It's just the next new turn in the capital markets and in the capital accumulation world. So all the things that have happened in the past are going to look the same. I have 30 years of experience doing emerging markets, and if I went from China and then to have people as the actors, and people tend to act the same in these situations. So we're just going through the next cycle of the human experience, going through growth and opportunity.
Well, Adam Draper earlier had a interesting point, and it's something that I talked to him in the past about this, and I believe in this as well. Is the future is going to look not like a different version of what it is today, but it's going to be this. This is going to be the future. Eventually, when I was doing, this is the next iteration of this, but eventually will take over. When I was doing a lot of crowdfunding work, I said, stop looking at the crowdfunding market as a crowdfunding market. There's a $7 trillion market in the United States alone for alternative investments. That's our market. We are going to take it over in some way. And there's a lot of the regulation side of things that are either could help us or be a big wet blanket on what we're doing, depending on which side we're on or which sort of vertical we're a part of. But going to that, I'll send this to Cliff and then back to Jeremy. I know Jeremy has a lot of thoughts about this as well. You have a bit of a legal background as well, aside from being at DNA. What do you think the legal hurdles, or what's the good thing and what's the bad side of all of the legal things going on right now?
Yeah, so I'm this combination of entrepreneur, lawyer, and so I both hate it and love it at the same time. Certainly, we're going to get the SEC, FINRA. For a long time, our whole space skated under all regulation because it wasn't quite. It's not a currency because currencies are state sponsored, and it's not a security because cryptocurrencies don't come with voting rights and other things that equity comes with. And then, really with the run-up late last year in the fall, now we have every regulatory agency saying, it's in our purview to regulate it. So, it depends on which side of the bed I wake up each morning, how I feel. In general, I do come out on the side of it's a good thing, right? The industry needs to mature, it needs to grow, and sure, it might mean the 100Xs and the 50Xs aren't as common anymore. But I think we're going to move to be a real true asset class and break the trillion level and really do what we know this industry is going to do, which is change the world, which it already is, but on a scale that we know it's going to be. We're going to have to play with everyone, and they're going to have to play with us, and it's going to happen sooner or later. So I like to embrace it.
As some SEC official said yesterday, ICOs demonstrate the need for securities laws. It's been a land grab of greed and crap and bad technology for the past 2 years, especially. I created the first utility token 4 years ago now, and back then we did it out of pure necessity. But what came after was just this windfall of entrepreneurs looking to raise undiluted capital, not actually giving any regard to whether the tokens they were issuing had any utility. And we need to crack down on that because no one's going to end from those investments long term. Yes, some of us may have had multi-100x returns in the short term, but long term, those tokens aren't going to be worth anything. So there needs to be better thinking about this technology. And just because nobody really answered this earlier, one thing that I'm really excited about in this space, and it goes back to this whole notion of being compliant, is the concept of a security token. A token that is a pretty much securitized, tokenized interest in a real world asset that has value and has scarcity, and it's just being put onto the blockchain. Because that democratizes access to all sorts of financial instruments that previously have not been available to most consumers. And that is a way to create tokens that are actually compliant by recognizing that they are in fact securities.
Yeah, I feel personally like the tokenized securities, and then on the flip side, the gaming type tokens are the two that are going to just send us into sort of terminal velocity. Because on the security token side, we're talking about there's Slice Market here and Securitize and Spice VC and those guys, and they're going to take something that everyone can understand. Like our parents can easily understand, buying a piece of real estate on the blockchain where I get to buy a slice of the Starbucks that I go to every morning. That's going to be an easy onboarding process. Try to convince them to invest in a company, in an ICO that I'm not a part of. It will never happen. So, and then on the game side, of course, I'm thinking about it from the mass audience perspective. If you get 1 million people with crypto wallets, it's a game changer, right? And every day you go into a room where 90% of the people in the room have crypto, right?
Well, speak for yourself.
Well, if you follow Jeremy around, then yes.
But I do have a caveat that I'm very much for regulating the industry. My only problem with the security laws is that the whole notion of the accredited investor. The concept of an accredited investor is ridiculous from a point of view of it's basically hoarding the wealth to the institutional. I mean, I say that as an institutional investor, it keeps it only for ultra high net worths. You're telling me that my parents who are doctors, who may are qualified as accredited investors, can make a better decision on a tech play than an IT worker making maybe 80 grand a year? I think it's not in spirit with what the communities have been building in the blockchain space.
I mean, absolutely.
There's two things there. First of all, that rule equates wealth with intelligence, which is not an established, well, as far as I can tell. And the second thing is that it locks you in to being poor, because capital and capital accumulation is about breaking the bond between your efforts and how much money you have a chance to make. So by telling someone who is not accredited that you cannot risk capital on these interesting opportunities with these asymmetrical risks means exactly what you're saying, which is you're going to stay poor, right? You have to keep working, and that's not fair.
But I will mention, and these guys don't get nearly enough credit, there are platforms like Republic Crypto that allow for Title III crowdfunding for unaccredited investors. And like those companies, if you are an unaccredited investor, you can participate in ICOs. And those platforms do exist, and they're growing, and the tools that they're creating are really fabulous, but they just need to receive recognition. Unaccredited investors can get involved. They should just follow the compliant path like everyone else.
Yeah, the issue though is you're absolutely right. And if those get mainstream exposure and if people are looking at it more from a marketing perspective, if I have a company and I want to raise the first $1 million from the public and hopefully that gets me 10,000 individual people giving me $100, that's wonderful. That's actually really, really awesome. And that would be great if enough people used it. But if it goes the trajectory of how the crowdfunding world works, which is first off, if I can hand James a piece of paper and he's an accredited investor and he can hand me over $1 million, that's way easier. I don't have to have audited financials. I don't have to spend a bunch of money just to be ready to launch on a Republic type of site.
The difference is though, if you're actually issuing a good crypto token, it probably needs network effects. And if you want network effects, you want as many investors as possible. And so the incentives for having unaccredited investors and going to a platform like Republic are exponentially greater than in traditional crowdfunding, because you're actually trying to grow your network.
You'll have a
as
public
fast as
token,
possible.
and you will not just public, but for the network effects of the actual.
So it's a bit different than crowdfunding.
Yo, you're absolutely right, but that's why I prefaced it with everyone should think about that in advance, because there's an easy path, especially if you have a deal that 10,000 people would be interested in. You'll have the same number of accredited investors who want to give you millions of dollars, right?
So
you have to do a duel.
If there are any entrepreneurs in the audience, if you are thinking about still doing an ICO, and you probably shouldn't be, but if you actually have a fabulous utility token, once again, you probably don't. But if you do, you should 100% be selling your token to unaccredited investors, but in a compliant manner.
Yes.
Don't forget the small guy.
So there are multiple rules that do that, and you can learn about them from a bunch of the sponsors, and you can go online and look up. There's something called Reg CF, which is the regulation crowdfunding. You raise up to $1 million from unaccredited investors, and then there's Reg A and there's Reg A Plus, and there's Tier 1 and Tier 2, and depending on the tiers, there's different rules and laws. And there's people that are tokenizing those along the lines of what we were talking about, the tokenized securities. So a lot of the crowdfunding platforms that were originally to the space are doing that, and a lot of newcomers are coming in specifically crypto related. But it's something you should think about. It's still new also, and you have to do it the right way, because you don't want people to think this is your last resort. You should make it the first stop and something you do in conjunction with a raise to accredited investors. You don't want people to think that I'm only on this platform because Jeremy didn't invest out of his fund. You want people to think that I'm on this platform because Jeremy wants me to be on this platform as a co-investor. That's for me how I would want to look at it from the perspective of a marketing person who's been a part of crowdfunding deals. A lot of the negative connotation of raising money through those rules are that they couldn't raise money any other way. This is the opposite. We're doing it because it's the best way to raise money, hopefully. So I'm going to bring back to Cliff, and I don't know off the top of my head, and I know I'm sort of intimately involved in some of the deals, full disclosure, but have any of the DNA companies yet used a Reg A Plus or a Reg CF type of offering yet? I know it's still so early on. There's only been a few very, very smaller deals in the crypto space so far.
Yeah, so none of our earlier deals have, but we have a couple security deals, Springroll, iCash. We're starting to see more and more, which is great.
Very cool. Now, there's along the lines of getting a bunch of people to have your token and getting that getting that exposure to the network and having a lot of people. So we talked about the side of the securities way of doing it with Reg A Plus or Reg CF. How do you guys feel about the airdrop model and how that is changing and evolving as sort of people realizing some of them are doing it right or wrong or how they're doing it?
So I just learned the other day that in 2000 or 2001, the Supreme Court ruled that you couldn't issue out securities for free.
Yeah.
And so there's actually very strong precedent for saying that an airdrop is a security. But CoinList just partnered with Republic, again, to create a compliant way of doing airdrops for tokens, where someone puts in $1 or $2, just a very nominal sum, and then they get free tokens worth exponentially more than that. And so there is a way to do this compliantly, but I just learned a week ago that you're treading a very fine line when you just give out tokens for free.
I think that, agreed. And you know, taking the securities laws aside because they're really undetermined and it's kind of we're random actors to figure out what the SEC comes up with in the long run. Airdrops are actually a really powerful tool. They represent the freemium role of the distributed economy. And because you're trying to get networks and you're trying to get users, I think that they're going to be a powerful tool once we figure out how to do it correctly.
Yeah, but they have to be pure utility, you know, to the extent they can, and really powered by the network that's dropping them.
Yeah.
I think that's like
in that particular case is really
it's a bit of the
works.
flaw in the actual, you know, the Howey test of, you know, technically it's defined as, you know, you're investing in something that's dependent on the performance of the entrepreneur and the business. That's not necessarily the case here because it's something in the gray area. Yes, it may be driven by what the entrepreneurs and the team do, but there's also a utility in it, and it's hard to define. It's gray, and airdrops kind of is where they stop.
I mean, there's also, you know, these clear rules, those same rules that in, you know, 2000, 2001 didn't want people giving free stock certificates because then you would go to their website and it would drive traffic, it would drive consumers, and it would raise the share price because more people had it, more people want to trade it, and it's very similar to the airdrop model. And then there's this other side of things too, where if every token is a security according to the SEC, then you
Looks like a security.
Smells like a security, tastes like a security.
So if they do decide that everyone is, which, you know, it would be crazy, but let's say they do, then you can't actually give somebody a security without even doing KYC on them. And so if there isn't some ability to know who you're giving it to, then that's a major problem. And it would be a bigger problem for actually the companies in the United States than the individual investors or anything like that. So I think, do you guys believe in this sort of idea of it being a bit of an exodus of the best companies sort of purposely setting up shop somewhere else? Do you think that this wet blanket of potential regulation is screwing with that?
Did anybody notice where Amazon's new headquarters is going to be? Canada.
Well, it's only a few miles away from Seattle.
Right, no, but think about it, everything's fractals, right? So what we're doing as a government right now in terms of imposing taxation and securities regulation is based on the assumption that you have a strong enough desire to be in the United States to bear the pain of being here, right? And at some point, there is a line that you cross where it's downhill on the other side. And so I think that you're going to find that securities transactions are going to move offshore unless the United States government finds a way to build a realistic and encouraging framework.
You have a bit.
James, I mean, I see that, but I also see really amazing companies here in the States not going anywhere. Really successful entrepreneurs that have proven themselves in the traditionally venture-backed space that see a revolution they can be a part of, and they're not moving anywhere.
I respect that.
And they'd rather comply with Reg A Plus or S&D, and it's going to just mean less liquidity for a while. But there's really great things happening abroad, in the Philippines and other places. But I mean, where we are here, it's the number of companies doing incredible things in our space is incredible.
For the exact same reason why it's hard to move tech entrepreneurship out of Silicon Valley, it's hard to move entrepreneurship out of America. This is a bastion of entrepreneurship and innovation, and just because a few stupid regulations get in the way doesn't mean that all of a sudden everyone's going offshore. The lazy entrepreneurs will do that. The hard-working hustlers, the guys that are going to build really world-changing companies, they're going to figure out how to adapt because they're Americans, and you can't really, well,
Also,
when they are Americans.
Also, it's like a very old school mentality of like if or, you know, like
If I
you're
don't get
assuming
my
like
way.
I have to be in the US or outside. I'm based in London. I moved my tech headquarters to SF. I have my operational here, but then we're doing a lot of our main sale outside. And yes, the US itself risks losing out on some of the innovation, especially in terms of governmental.
Yeah.
A lot of the fixes to government are happening abroad that you don't see that kind of excitement. But you know, it's you can take advantage of both in this
I mean,
environment.
it should be truly global. It should be pretty easy to work around the world and stay where you are and do it right. My favorite thing is I do this networking group that's about an hour north of LA called 805 Startups. And my favorite thing is to give shit to my friends who tell me that they live too far away from LA for investors to invest in them. And I go like, are you freaking insane? If an investor was interested in your company, first of all, the meeting is an hour away. You can drive there. You're okay. Like, but it's the biggest.
They're
easiest
just too
excuse.
lazy. Let's
They're just
be
too
real.
lazy, right? So is you do hear companies going like, oh, we wanted to do this, but you know, like we're worried about this. We're worried about. Is that an excuse to an
No,
extent? I mean,
it's
or
a
is
piss
it,
poor
yeah,
excuse.
yeah.
It's a reason not to invest in those
Yeah.
teams.
Exactly. I mean, where is Warren Buffett located? I mean, Nebraska. I mean,
But also, back to your point,
Yeah.
you know, Delaware is a little island in the middle of nowhere, right? But it has, you know, some huge percentage of the incorporations in the United States because they made it easy to do it there. They were business friendly. They passed laws and they built their taxation system in a simple way. You know, if we go bigger and say everything's fractals and look at the world and the countries instead of states, how easy is it to move to Malta, your business? You don't have to move physically, but move your business to Singapore or the British Virgin Islands. I just, you know, so I agree, you know, that America's great. I'm American. I love America. But I also think that, you know, that blockchain is, and this whole concept of decentralized vote is about voting. And you're voting with your activity and voting with your money and voting with your attention. And so I do think that we do have to pay attention to that if as a country we want to succeed and stay on top.
that's true. I do want the regulators here to actually take it seriously and actually have proper tech insight and make a ruling. You know, if you're going to make it security, rule on security so I can assign equity to it, so I can pay dividends out to my token holders. So you're not allowing either or here. So that's the problem.
But people really forget that regulators' hands here are tied. Regulators' jobs is to enforce the law as it's written and ruled by the court system. We have this whole new asset class, like technology paradigm. They can't really create new regulations for what we're doing. The only thing that's going to change the status quo is new legislation. I don't think all of a sudden the SEC or CFTC or FINRA are going to suddenly just come out with broad proclamations about how this technology is treated. Right. If you break the law, if you commit fraud, if you do something that really creates something that looks like a security and you're not calling it a security, then you're probably going to get in trouble. But if you're an entrepreneur trying to innovate and create like a novel technology, the likelihood that regulators are really going to hound you and cause real headaches for you is quite limited from our experience thus far.
Yeah, so you know, you're saying this sort of uncertainty is bad because they need to just create something. I almost feel like the uncertainty is like, as long as you're good and you're doing good and you're not screwing people, you're not a fraud, you shouldn't get in trouble, and hopefully they continue to not get people in trouble for that. Because I think the only problem with regulation in the space is that they could be faster at picking off the really easy, obvious fraudulent things that are going on.
I want them to prosecute more people. like there's so much fraud in this space, it would actually help us clean up and professionalize.
You know, we've been pointing at regulators and legislators. Like, really, we need to be pointing at
Ourselves, right?
we need to be pointing at ourselves, right? A lot. Like, how are we acting in the space? It's so new. What we are all, everyone in this room on the stage are doing right now matters because we're building the foundational layer of the space. You know, where are we putting our money? You know, what kind of entrepreneurs are we supporting? Are we tolerating really crap investments and opportunities just because it looks like a quick score? Are you not calling out pump and dumps when you see them? Like have a responsibility as leaders in the space, as participants in the space, and that's the thing we have the most control over is what we do.
So back to Jeremy's point, there's the assumption, and we go by this assumption in my shop as well, that if you're a good actor, that you'll have a better chance of surviving whatever changes come down the road. But that's an assumption, right? We don't know. And what we do need is some level of certainty. I mean, we joke around my shop that we need one or two really good lawsuits, right? Because if the legislative and the executive branches are not going to give answers, then we need the court system to tell us.
Well, and that's what we have
Yeah.
Wyoming for now. We have this new testing ground for utility tokens.
Yeah, exactly.
Yeah, we haven't heard anybody talk about it yet today, and I haven't done a lot of talking about it, but I do know a few people who are setting up similar to Delaware, like you were talking about, sort of setting up shop in Wyoming. How do you guys feel about that? Do you think that's, it's too early to probably,
It's a great way to create case law. But
Right.
Wyoming is the least populated state in the nation. And if the law only applies to Wyoming, you've got about 1 million people to sell your token to. But what we can do is use this to create a challenge to any sort of federal law and federal ruling that will create good case precedent. But that's going to take some time.
So we are, we're getting close to our time, so I want to keep going down this path, but I want to find a good way to put a cap on it. So let's go back to the because I think we can do this for hours. But the audience, raise your hand if you're an entrepreneur in the audience. So that's what I thought. About half or more are entrepreneurs, and we're a crypto fund panel. So what I would love, we'll go opposite way this time, from Cliff back down. And I would love for you to give sort of either one sort of fast tip or an anecdote, a little story about a company that did it right. Not like let's keep it positive, not like a company that totally blew it because they did something stupid. Let's think about something like, what do you like? Like if you see a company pitching to you guys, what's your favorite thing?
I mean, a few things. The team really is like one, two, and three. What's your personal story? What's your connection to why you're doing it? Is that genuine, or is this just an idea that you heard somewhere and are trying to make money off of? Preparedness as well. Like I can't tell you the number of. We at DNA provide a whole deck that shows you how you should prepare, and even a great idea and even a decent team can come in unprepared, and how you do one thing is how you do everything. And so what we really look for is, I mean, there's a bunch of factors, but a genuine connection to your story and coming in sharp and bringing your A game.
Prepared and polished. Jeremy.
Yeah, I mean, you need a team, you need a good addressable market. If you're creating a token, you have to understand game theory and incentives, or else your system isn't going to work. But probably the best project I've seen do a sale in this space is 0x. They did a phenomenal job of, they had some very early investors, raised a couple million from them, then said we're going to do a $27 million cap. There was way more demand than that. Then we're going to prorate every single investor so everyone gets the same amount, and everyone that gets whitelisted can participate. It was beautiful. Everyone got in. Everyone had like a 15x return in a day. But more importantly, they created a really strong community because everybody was able to participate.
They didn't have to turn people away.
They have regular developer updates. They're constantly talking about how they're thinking about compliance. They're doing a bunch of project outreach. They've got like a cult around them. And that's what you want when you're creating an open source project. You want to have like a cult-like following behind what you're doing. And so 0x, if you want a great case study in how to do a blockchain project right, they're the team to look at.
Shank, what gets you most excited on a pitch?
Sure. I use normal VC analysis. I mean, yeah, team and idea and passion is fine. I want to see a business model. I want to see, are you actually going to make revenue? Or is this just a passion play?
What's that?
Exactly.
We don't do revenue in this space.
You can't do valuation
Usually
in
you're
revenue.
building a business. I do social good. If you want to make an impact company, do social good. It's not just about money, but
It better make money.
Make it sustainable. I mean, look at Elon Musk. It's about sustainability.
Right.
Don't just rob all your ICO investors and walk out the door. I mean, make something that actually benefits someone, but is sustainable. And I mean, not to promote my own company, Bubblo, but we had a business model. We had multiple VCs in the door, and then we integrated it, right? Yeah. So obviously, I look for early stage investors. Hopefully, you're not doing it by yourself. You have some, guidance and some discipline. One of the great things to see of having a traditional VC or even something like the funds up here is that they provide discipline. They make you think about your business model, poke holes in it. Hopefully that you go back and try to answer those questions. I've met a lot of people around the world where no one's actually poked a hole in them. They're already talking about raising 30 million. I'm like, some guy actually approached me and said, he wanted to do a medical company or something, and he's like, I said, well, why do you want to do an ICO? He's like, yeah, well, because I don't want to give away equity. I'm like, are you really even telling me that? Why would you even tell people that? Like, so stop. There has to be discipline, like he said. Like, hopefully, some of these court cases actually bring discipline to it. This is not free money. You're building a community. You owe it to the community to make a return and make it sustainable. So, yeah.
James.
So our gating issues are vision and passion, which apply personally to the people who are pushing forward the projects. So they're solving a problem that they passionately care about, and that a lot of other people would benefit from the solution, so that you can end up with an asymmetrical opportunity and investment. Let's restart.
Cool. Well, I'm sorry we're out of time for this one. Give a round of applause for the amazing panelists. Yes. Thank you guys for coming.
Thank you. Good job.
Thank you.
Good job, buddy.